Alright, so welcome to part 2 of my top 5 stock market forecast for 2023. If you have not watched part 1, do pause this video, go watch part 1 and I'll see you back here in part 2 in a couple of minutes. My fourth forecast is that the Chinese stock market has entered a bull market and the bull market is only at its beginning stages. Now, if you take a look at this chart, you can see that the China market, specifically the Hong Kong market, it has been in a bear market for over 1.5 years over here. And all this was due to all these issues, right? It began with the government's regulatory crackdown on tech companies like Alibaba and Tencent, and the crackdown on the education sector that scared away investors. And then we had the real estate crisis that the Chinese government created themselves by forcing real estate companies to reduce their leverage and follow these 3 red lines, which a lot of them couldn't do, so a lot of them kind of like imploded. The Evergrande debt situation. Of course, China then going into this crazy zero COVID policy for 3 years, isolating themselves from the world, and all this slowed down the economy. Now, everything has changed in the last 2 months. The Chinese government has totally reversed all their policies. So now, the regulatory crackdowns are over. In fact, now the government is beginning to assist the tech companies to grow again. In fact, they just approved the Alibaba Ant Group to raise new capital. So that's signaling that the Chinese government is now going to help the tech companies because they know they need the tech companies to grow the economy. So now they are actually in that stimulative framework. And next, the Chinese government is now going all out. They're going to do whatever it takes, like the Avengers, to rescue its ailing property sector. And they are now contemplating removing the regulations, the 3 red lines that cause the property companies to get into trouble in the first place. All right, so that's over. And of course, we know that right now, they did a big 180 and they abandoned their zero COVID policy. And now China's government is reshifting its focus to boosting its economic recovery. So everything has changed. China has now reawakened, all right? It's the second biggest economy. And you can see that throughout this entire bear market, the index never got above its 200-day moving average. Now, you can see since it bottomed in late of October, the Hang Seng index is up 44%. And it's just the beginning. You can see that it just crossed above the 200 moving average. And whenever a market crosses above the 200 moving average, and you see the 200-day beginning to flatten and slope up, that is a very powerful long-term bull market signal. So I think there's a lot of room to grow, a lot of huge gains ahead, right? So in fact, after growing 44%, I think the Chinese market can still grow double digits this year and possibly even outperform the US markets for 2 reasons. The first reason is that China's market is still extremely undervalued, even after surging 44%. If you look at the China Hong Kong Hang Seng Index, it's now selling at a PE of 9.6 times earnings. 9 times earnings, that's bloody cheap, right? If you compare it to the US market, 20 times earnings. So China is half price of the US. Now, you could argue that the US is growing faster than China in terms of their corporations, but then again, China's still really, really cheap. The other thing that's different is, remember, the US and China are on opposite monetary policies. While the US is on a tightening monetary policy, in the US, they are increasing interest rates. They are reducing money supply. In China, it's the complete opposite. China, they're doing whatever they can to stimulate the economy. They are cutting interest rates. They are increasing the money supply. So all this is causing a huge run in the Chinese market. So you can see the PBOC, the central bank in China, targets stimulus as China focuses on price risk, which means to say they don't mind creating inflation in China, right? So it's a very different metric over here. So there are many ways to, of course, ride on this bull market in China. If you're not comfortable owning individual companies like Alibaba or Tencent, you don't know which are the good companies, you could look at ETFs, right? So for example, one of the ETFs is the KWEB ETF. This is the Chinese internet ETF listed on US markets. And you can see, again, it's been in a bear market for over 1.5 years. And right now it has begun to cross above the 200 moving average. And all the way back to the top, you have got a huge upside potential of almost 200% gain just to get back to where the bear market started. And of course, if you go beyond that, there's a lot more potential ahead. Now, of course, disclaimer, I own a lot of Chinese stocks as well, right? About 10% of my portfolio are in Chinese equities, and I also have placed some short-term trades on KWEB and other Chinese stocks and ETFs. And I've also been buying up more Alibaba, in fact, a couple of months ago. So yes, I am heavily invested. So in full disclosure, right? Okay. So the fifth forecast is that this year, I think that the sectors that would have the best chance of outperforming would be technology, communication services, and consumer discretionary, because they were the worst hit sectors last year. So this was last year's performance. The S&P dropped 19% last year. But if you look at the different sectors, there was a big disparity in their performance. And of course, last year, the best performer was energy because of the Ukraine war, causing oil prices to go up. But that's, started to come down right now. And the three worst performing sectors last year was technology, like your Apple, like your Microsoft, like your Salesforce, like your ServiceNow, okay? Consumer cyclicals, also known as consumer discretionary, same thing, right? So consumer cyclicals are your Nike, your Lululemons, your Amazon, your Home Depot, your Lowe's. Those are your consumer cyclicals. And next, communication services, the worst performing of the lot, like your Netflix, your Meta, your Alphabet. These were the three worst performing sectors. Now again, why were they so badly hit last year? Because of the very fast rise in interest rates. That is what caused these three sectors to really, really sell off. Now, here's the interesting thing. Although they're the three worst sectors last year in the short term, but in the long term, these three sectors tend to outperform the S&P 500. Because companies within these three sectors tend to have larger, higher profit margins, higher return on invested capital, higher growth rates, and stronger economic moats. If you take a look at, again, the longer term view of the market, you can see this is the S&P 500 ETF right here. And in the long run, which sector outperforms? Again, technology. Why? Because technology companies have higher profit margins, higher return on capital, higher growth rates, higher scalability, all right? Consumer discretionary. Many of them have strong brand names, sustainable competitive advantage, and communication services, which you don't see here because communication services was only recently introduced in this chart. So you don't really have that data going that far back. But if you look at the companies within that, like Alphabet and Meta, for example, or like Netflix, they have way outperformed the market in the long run. And last year, the sector that did the best, energy, yes, in the short term, it can do very well, but in the long run, energy, utilities, and materials, they tend to underperform the market because they tend to have lower profit margins. They are very competitive. They've got higher maintenance capex and lower returns on capital, all right? So the opportunity is that you've got the three best performing sectors at its cheapest point because they sold off last year. And usually the worst performing sector in 1 year will tend to become the best performing sectors in the years to come because the market is a mean reversion machine, right? It reverts to the mean. Worst off becomes best off very often. So if it's not this year, it'll be next year. And again, so there are few reasons why I expect these three sectors to perform. Number one, they possess the strongest operating margins, or in other words, profit margins. If you take a look at this chart, this is from DBS, Bloomberg Research. You can see again the technology sector and communication services sector, their profit operating margins in red and yellow are way above the S&P 500 broad market profit margins. So the companies are just more profitable basically, right? Next, They have the highest projected earnings growth potential in 2023, with technology at 11%, communications 10%, and consumer discretionary at 27%. All right. The third thing is that if what I say is right, inflation remains moderate and the 10-year treasury yield continues to go down, then earnings multiples should expand, right? Your PE multiples, your price to sales multiples. And you can see that these three sectors, technology, US consumer discretionary, and services, are projected to have both positive earnings growth next year and positive revaluation of price multiples. So this is what can drive their stock prices higher. So does it mean that all stocks within these three sectors will do well? Not necessarily. So I will only want to select the companies that have got strong earnings growth or share buybacks and or good dividends. That will drive the share price higher. Now, some people think that, Adam, the stock market cannot go up unless the Fed pivots, unless the Fed cuts interest rates, unless the Fed increases money supply, stocks can't go up. Is that true? Yes, it is true for companies that don't make money. It is true for companies that don't do share buybacks, that don't pay dividends. Then they just need money supply to pump the share price up. So what you have to understand is that there are altogether four things that drive a stock's price gains. What are the four things? Number one, most important thing, are earnings per share. When a company increases its earnings, it makes more money, the shares are worth more, right? So you can see this light blue, this contributes to the share price gains. Now, besides earnings per share, the next thing are share buybacks. So when a company buys back shares, it's a way of returning capital to shareholders. When they buy back share, each share becomes worth more. So share buybacks also drives price gains. The third is when a company pays dividends. When you pay dividends, you collect dividends, you're willing to pay more for the shares because of a dividend payout, right? The fourth thing that causes the share price to go up is PE multiple expansion. That means people are willing to pay more for the same earnings per share. And what causes PE multiple expansion is the Fed's monetary policy. So when the Fed cuts interest rates, when they increase money supply, PE expands. When the Fed increases interest rates and they cut money supply, PE shrinks, right? So right now, what's happening? You see, in the last many years, when the Fed was printing money, when the Fed was lowering interest rates, stocks could go up easily. Even without earnings, without dividends, without buybacks, prices can still go up because of PE multiple expansion. But now that there's no PE expansion, because the Fed is not cutting interest rates, they're not printing money as easily, then you need earnings per share growth, or dividend growth, or share buybacks. You need these three things for the stock price to go. And that's why it's very important in this year for you to only pick stocks and to hold stocks of the highest qualities. If you're holding stocks that are not making money of low quality, they ain't gonna go up. And that's why it's really important to understand how to analyze only the best, highest quality companies in the market. You can see from this chart that in the last 10 years, 14% of the gains of the S&P 500 did not come from earnings, did not come from dividends, did not come from buybacks. They came purely from PE multiple expansion, which is purely from the increase in money supply and the Fed cutting interest rates. So how do you get 14%? So again, the PE multiple expansion is 48.4. If you take 48.4 divided by 337, which is the total gain of the market, that gives you 14%. So what does that mean? So again, what this means is that even if the Fed doesn't pivot, even if the Fed doesn't lower interest rates, the stock market can still go up, but you go up less. It'll go up about 14% less. And it also means that if you focus on companies with high earnings growth, high share buybacks or dividends, you don't need the Fed to pivot. These companies will go up regardless. And these are the companies that I own. Now, a lot of people ask me, Adam, why do you start buying, stock when it's in a bear market? When there's so much uncertainty and so much pessimism? Why don't you wait for there to be clear skies ahead, when there's a confirmed bull market, when there are no more problems to start buying stock? Well, if you take a look at this chart, you understand that, ironically, the safest time to buy high quality companies is when you buy them when the price is undervalued, when you're getting a margin of safety. Now, when are high quality stocks cheap? When people are fearful, when people are pessimistic. So that's when you get the best deals. That's when it's the safest time to buy. And sure, the price could go down even lower in the short term, but it doesn't matter, because eventually, once the bull market starts, when you get in early, you get the highest returns over time. You can see that during the 2020 bear market, when the market bottomed in March of 2020, by the time the media told you it was safe to buy, it was 11 months later, on the 7th of February 2021, when they said the stock market is bouncing back for the right reasons, right? Time to buy. And by the time they tell you it's time to buy, guess what? The market is already up over 70%. So you're buying in at a premium again. You're buying in when stocks are no longer cheap. If you want to get in when stocks are cheap to get the highest returns, you got to get in when there's pessimism, bad news. Remember, bull markets are not born on optimism. Bull markets are always born on pessimism. And the markets always climb a wall of worry. The early stages of a bull market never look like a bull market. In the early stages of recovery, in the early stages of a new bull market, you find that most people are in disbelief. Most people are in denial. And the media is always telling you why it's going to fail. Like, for example, at the bottom of the bear market, when you should buy, what did the media say? It says, the worst sell-off isn't here yet. Banks and investors warn. Over here, when I started buying, it says economists fear drawn-out slump as losses deepen further. Over here, equity market rally runs out of steam. Really? Right? Over here, stock market investors are too optimistic. Really? Okay. Over here, stock surge is a bear market rally that will collapse. Really? No, it didn't. It went up another couple 100%, right? All the reasons the stock market gains are not to be trusted. Stocks may have hit a ceiling over here. Some investors are making the biggest bet against the market in 9 years. A lot of people are shorting the market at this point of time. The coming earnings season could bring lofty stocks down to earth. And over here, official announcement of a recession. So notice, when they announce a recession, that means that the bull market is going to continue, right? Over here, big tech stocks are struggling. Small tech stocks could be next. All the freaking bad news, dudes. You want to buy when there's freaking bad news, because when there's good news, it's too late to buy, right? So think about it. Now, again, am I saying that the bear market is over? I'm not saying that, right? We could still go lower this year. Everything is possible. But what I can say is this. There are a lot of bargains in the market right now, and I have been buying and I will continue to buy. As long as you buy great quality companies that are showing earnings growth, that are buying back shares or paying dividends, you will get really greatly rewarded in the next couple of years to come. Because remember, we are only at the middle of this secular bull market that's going to last at least another 6 to 10 years. Hope you enjoyed this video, and I'll see you in the next one. Have a great year ahead, and may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com, where you're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.